We begin now with breaking financial developments that are rattling markets and commanding global attention. The Vietnamese Dong and the Iraqi Dinar are at the center of a storm that is escalating by the hour. Confidence, speculation, and geopolitical pressure have combined to ignite what analysts are calling a final countdown, and the consequences are opening up fast across continents. Investors, remittance corridors, currency traders, and households in both Vietnam and Iraq are watching developments unfold in real time, as if on a ticking clock. What began as subtle tightening movements has erupted into what seems like a culmination, an urgent moment in global currency vigilance. Market participants tell us that the Vietnamese dong is showing signs of accelerating pressure against the US dollar. Seasonal inflows, such as those tied to export receipts and remittances, are being offset by increased demand for foreign currency among corporations bracing for rising global interest rates and commodity volatility. At the same time, whispers of impending central bank action have intensified speculation that a recalibration of policy is imminent. Foreign exchange intermediaries report markedly higher volumes on both buy and sell sides. As corporations scramble to hedge, importers rush to secure purchase orders, and cautious remittance receivers delay currency conversions in the expectation of intervention. The result is an unmistakable tension building in the FX market, one that suggests perhaps the State Bank of Vietnam is now watching the clock, wondering whether to let the pressure build or to act decisively. In parallel, the Iraqi dinar is drawing extraordinary interest of its own. Rumors have been swirling that Baghdad may be preparing, or being pressured, to allow a revaluation of the dinar. News channels and online platforms have been awash with speculation, even though officials remain outwardly muted. Traders in Gulf financial centers and expat communities observe that volume in dinar-related transactions has spiked, not on standard trade flows, but on speculative channels. People are calling in mobiliaries, pushing for pre-exchange clumps, while online forums are abuzz with talk of a reconsolidation that could suddenly lift the dinar to levels unseen in years. Yet formal announcements remain elusive. The uncertainty has intensified, giving life to what could be a climactic moment, what some are dubbing a countdown to a dinar revaluation, or perhaps a sharp interest rate pivot to defend the currency. The convergence of these two separate but parallel currency dramas raises stakes for global macro watchers right now. Imagine portfolios that are stretched across emerging market assets, remittances that sustain families across thousands of miles, or corporate supply chain flows that hinge on FX stability.
The squeeze is amplifying.
Every cable rate movement, every hint from central banks, every geopolitical rumble from the Middle East and Southeast Asia is magnified. And that is why the term final countdown is now being uttered with weight by both analysts and commentators. In Hanoi, banks are reportedly placing limits on the daily volume of foreign currency they are handling, citing exceptional circumstances and urging customers to come back tomorrow. Those dealers say internal communication from the state bank signals a readiness to intervene, but not before the market stresses itself out enough to justify a stronger move. It's a balancing act between managing external reserves, defending the exchange rate, and avoiding giving in to panic sentiment. Meanwhile, financial controllers say that importers are accelerating payments, fearful of potential tightening of dollar supply. Exporters, on the other hand, are holding off converting dong into dollars in anticipation of better rates. The tug-of-war is negative for liquidity, and it is cutting both ways. In Baghdad, meanwhile, banks carrying dinar reserves are seeing customer inquiries spike, with depositors asking whether to convert their savings into US dollars, make contractual transfers, or sit tight. The Central Bank of Iraq has remained deliberately quiet, deliberate or maybe simply cautious, but analysts note that quiet may be proof of busy preparation. There has been talk of monetary reversion or monetary realignment, phrases that, while unspecific, feed the urgency. Some regional governments are said to be watching closely, eyeing Iraq's own inflation and oil income trajectory. Pressure from international partners could tip the balance in one direction or another. None of this is comfortably settled. Across social media, the mood is charged. Conversations in diaspora groups start with posts like, "Is this finally it? Should I convert my dinar stash now?" Has anyone seen the dong move today? Where once such chatter was niche, now it is mainstream. That's not just idle banter. It's a rising tide of sentiment that can feed a market spiral. Fear of missing out prompts action. That action creates movement. That movement attracts more attention. And so the countdown accelerates. Traders in Singapore report seeing offshore dong forwards pricing begin to climb, signaling that market expectations of depreciation are rising. Term premiums reflect that there could be a marked shift sooner rather than later. Simultaneously, in Beirut and Amman, field brokers dealing in Iraqi dinar say that dollar-dinar spreads are narrowing for certain tenors, indicating that demand for dinar could soon outpace supply. Both instruments are feeding into a broader timer-like effect where the mere perception of an upcoming reset drives positioning. Every tick upward in implied volatility underscores that we may be approaching a flashpoint. On television screens around the world, financial networks are now dedicating segments to the phenomenon. Currency desks in London, New York, Dubai, and Singapore are tagging it as one of the most intriguing latent stories of 2025. Dong watchers, a term once used only by niche FX traders, now describes a handful of journalists stationed outside Hanoi's head offices. Dinar watchers are those tracking Iraqi monetary policymaking and remittance corridors. Corporate treasury teams are texting each other, comparing cross rates, scanning legal memos on capital controls, and reviewing contracts for force majeure if rates swing unexpectedly. The urgency is palpable, but caution remains. Economists warn that nothing is certain. A sudden intervention from the State Bank of Vietnam could stabilize the dong temporarily, especially if backed by sales of foreign reserves or a tweak in policy rates. In Iraq, a premature revaluation without the macro fundamentals, such as controlled inflation and credible fiscal backing, could spark instability rather than confidence. The final countdown has begun, but the outcome is undecided. Any move will unfold under intense scrutiny. Observers note that central banks in both countries must weigh market optics, international credibility, and domestic needs, all under a compressed timeline. Currency speculators lurk at the edges. Any sudden spike or pivot, especially if consistent with leaked or foreseen announcements, will trigger algorithmic chain reactions. The risk of flash moves is high. These are not the measured shifts of years ago, but potential gales breaching markets in minutes or even seconds. Major banks and high-frequency traders are positioning quietly, ready to pounce should either central bank signal intention. That further accelerates the countdown, forcing policymakers to carefully choose words, timing, and execution.